Welcome to this Executive Explainer. Listen, if you're a founder or a C-level executive looking to scale a business in Tajikistan or the broader Central Asian region, you really need to hear this. We're talking about a trap. What looks like an easy, low-tax path forward right now might actually be a fatal structural flaw just waiting to swallow your entire enterprise. Let's dive into it. Here is our roadmap for today. We'll unpack the patent illusion, move into the B2B quarantine, explore the financial black hole, navigate the fragmentation trap, and finally, figure out how to architect your exit. Okay, part 1. The patent illusion, otherwise known as the B2C sandbox. So what exactly is the fixed-fee patent regime? At its core, it's an administrative sandbox. Fiscal authorities engineered this as a super low-friction entry point for localized B2C trading. Think about your neighborhood baker, a subsistence farmer, or maybe a solo IT consultant working out of a coffee shop. They pay a flat, predictable monthly fee, and boom, they trade fiscal transparency for absolute simplicity. No complex tax declarations. Now that's brilliant for getting off the ground quickly. But, and this is absolutely crucial to understand, it is explicitly designed for subsistence trading. It exists to formalize the informal economy. It was literally never intended for commercial scaling or enterprise-level growth. And here is where the whole thing breaks down. In that B2C sandbox, you have no general ledger, no double entry accounting, and no verified operational prime costs. Honestly, skipping all that paperwork sounds fantastic when you're a scrappy startup, but real B2B scale, that demands verifiable solvency and strict standardized accounting. To a major corporate partner, running on a patent basically looks like you're managing your finances out of a shoebox. So what starts out as this cozy, low-cost tax haven instantly becomes an impenetrable structural barrier. Without verified records, the broader financial ecosystem cannot validate your actual revenue. You've hit a glass ceiling and you've systematically legalized your own operational fragility. Which brings us to Section 2, the B2B quarantine and your supply chain isolation. When you're ready to scale, you naturally want those big institutional clients, right? Large manufacturing plants, international contractors. Well, those guys operate under strict general tax regimes or specialized VAT frameworks. For them, their corporate taxable base is strict statutory math, gross revenue minus documented vendor costs and deductible expenses. To deduct those costs, they absolutely require standardized statutory fiscal invoices. Why are they so obsessed with this? Because if they can't legally deduct the cost of doing business with you, they effectively have to pay taxes on the money they just handed you. No corporate buyer is going to take that hit just to work with a microbusiness. This creates a massive divide in how procurement departments categorize vendors. You have your standard vendors, who provide clean, deductible expenses and VAT offsets. Smooth sailing. Then you have the patent vendor. Because those expenditures can't be cleanly expensed, an enterprise CFO looks at a patent holder and instantly flags them as a toxic counterparty. The administrative headache is just too high. You aren't offering them a bargain. To them, you're a walking tax liability. And here's the crazy part, because the psychology of this trips up so many ambitious founders. You might be thinking, hey, I'll just discount my way into the deal. But even if you drop your unit price a full 15% below market rate, the math simply does not allow the corporate buyer to say yes. The total inability to claim VAT credits on their end completely obliterates any savings you're offering. Your aggressive pricing strategy is basically meaningless because the institutional buyer is structurally penalized for doing business with you. You're completely quarantined out of high-value supply chains, period. Let's look at Section 3, the financial black hole and capital starvation. True corporate wealth is built through enterprise valuation and leveraged debt financing. But institutional lenders and foreign direct investment funds absolutely rely on auditable financials. They need a balance sheet, an income statement, verified EBITDA. Because the patent operates completely outside standardized double entry accounting, you're generating exactly zero historical financial equity. You could run a highly profitable cash cow for 5 years, walk into a commercial bank for an expansion loan, and you'd literally be laughed out of the room. You can't pledge corporate collateral, you can't execute an institutional valuation, you can't even pass basic compliance due diligence. On paper, you just don't exist. You are entirely financially invisible to global capital markets. Moving on to Section 4, the fragmentation trap, or what I like to call regulatory doom. As that revenue ceiling rapidly approaches, founders instinctively ask a very dangerous question. How do you bypass the growth cap? This is where the panic sets in. And unfortunately, this is exactly when operational accountants tend to offer some terrible advice. They direct founders toward a fatal compliance shortcut, artificial business fragmentation. It gets treated like a clever little life hack in emerging markets, but in reality,
It's a ticking time bomb.
It usually goes like this. Instead of operating as one true economic unit that legitimately exceeds the cap, operations get illegally fragmented. A founder registers patent number 1 to their spouse, patent 2 to a cousin, patent 3 to a nominal employee, all to keep the illusion of being a small business and stay under the radar. It feels like a victimless workaround to keep enjoying those low, fixed fees while quietly scaling your revenue. But that workaround is now a massive existential liability. We live in an era of rapid state digitalization, automated banking cross-checks, and centralized electronic POS monitoring. Artificial fragmentation isn't hiding in a filing cabinet anymore. It's a glaring, easily identifiable tax evasion trigger. Modern digital audits are incredibly sophisticated. Tax authorities can literally match the IP addresses used for tax logins across those supposedly separate patents. They can seamlessly connect the dots on bank transfers flowing between relatives, and when they do, regulatory auditors will effortlessly collapse those fragmented entities back into a single economic unit. The retroactive tax assessments, statutory fines, and compounded interest, they frequently exceed the liquidated value of the entire enterprise. You aren't just hit with a big bill, your company is destroyed. All right, Section 5. Architecting the exit as a strategic imperative. We have to engineer the solution. I absolutely love this principle. A professional financial architect does not treat the patent as a long-term operational strategy. This demands a fundamental mindset shift for C-level execs. It is so easy to get emotionally attached to the low-tax, low-stress Sandbox. But you have to remember, it is just a temporary incubator. It's a fantastic tool for initial market validation, but it is nothing more than that. The strategic roadmap is crystal clear. Step 1, use the microbusiness regime aggressively during your market validation phase. But step 2 is the real game changer. You need to engineer a mathematically defined architectural trigger point. This isn't some painful transition to higher taxes. This is an exciting graduation into the major leagues. It's how you unlock institutional credit and foreign direct investment. From day 1, you must plan for step 3, transitioning to a transparent, auditable corporate architecture. Whether that's an individual entrepreneur certificate with formal payroll or an LLC ready for VAT supply chain integration, your exit has to be calculated. True growth fundamentally requires leaving the comfort of the sandbox. So, I'm going to leave you with this to consider for your own venture. Will you remain a toxic counterparty, financially invisible and forever capped by the illusion of the sandbox? Or are you going to engineer your corporate architecture from day 1 to play in the major leagues? The choice and the future value of your enterprise is entirely up to you. The ceiling might be made of glass, but you're still going to need a hammer to break it. Thank you for joining this explainer.